Figuring this out is actually quite hard. To invest your savings or pay off bits of your mortgage early. Which is it? On one hand, you have personal finance experts like Dave Ramsey say things like this.
On the concept of why would you ever pay off a 2% mortgage when you can invest it at 10? That's a standard question. And he's right. He's a new listener. It's a good conversation. Thank you for calling in with that, by the way, because people think we're crazy for suggesting you do pay it off. But the rationalization or the justification, the reasoning, none of that. The reasoning for the advice is that it's right because the data shows that the borrower is slave to the lender. The data shows your relationships are different, your career path changes.
Which, look, makes complete sense. The bigger your mortgage, the bigger burden you've got over you, which will inevitably affect all of us differently. But on the other hand, you have a whole bunch of other people like Leeds say things like this.
If you own a house, most people will tell you to pay it off really quickly. But that is actually not smart because it's going to take you 40 years to do that. And then you've got a house that you own outright, good for you, and you're old and grey. You're much better off to take your house and to refinance it and buy lots of houses.
So look, on both sides of the argument, you have well-known people making opposing arguments. And what makes this also difficult is both sides of the argument are right, dependent on your situation and your risk tolerance. In this video, I'm going to break down how you can think about getting that balance right for you using my decades experience building a UK-wide home buying company, British Home Buyers, nationwide estate agency, British Home Sellers, and my own personal equities and property portfolio. So let's start talking about the benefits of paying off your mortgage. Now, I'm not going to talk you through the obvious things. We all know that paying off your mortgage reduces the money you spend on interest and lowers your risk because you have less debt. So if your mortgage rate is 4% and you pay off a chunk of your mortgage, that money you've invested to pay off that chunk of your mortgage early is paying you, in effect, a guaranteed 4% return because it is saving you that 4% you would have spent on your mortgage instead. The main reason in particular investors say, no, don't pay off your mortgage is because if you can make a higher return on your money than the mortgage interest is costing you, that 4% for instance, it makes far more sense to invest your money instead to make the higher return. So if your mortgage is 4%, you can buy an investment that pays you 8%, let's say, then the logic is you should buy the investment instead of paying off a chunk of your mortgage. But although that sounds logical, you've got to balance in risk. Risk itself has a cost, and it's a hard cost to quantify. So when does paying off your mortgage make sense? It makes sense when you've already covered all other greater risks to your financial stability. So what does that even mean? Well, really, when you're deciding how much to invest against how much debt you want to pay off, you need to be thinking about risk. Dave Ramsey, who's a well-respected US-based money expert, has coined what he calls his 7 baby steps. And I like these because it illustrates how you should prioritize building your wealth, accounting for risk. Firstly, by having an emergency fund, then paying off all debt other than your mortgage, then starting to invest more for retirement, for instance, and so on. I'm not going to run through all of them because you can just read them, but you do also need to consider these are not set in stone rules. There are lots of people that disagree with Dave Ramsey's wealth building philosophy altogether. So for instance, I don't only invest a proportion of my income into my pension before paying down my mortgage, but I also invest a certain portion of my income, of my profits, into investments like property and equities as well. So I've decided to create more of a split where I'm overpaying more of my mortgage, but I'm also investing outside of my pension in things like property and equities in particular. But even then, there will be people that think I've made prioritizing paying off my mortgage over investing more in property and equities. People might think that's ridiculous. At the end of the day, you need to make your own judgment, but in general, it works well to create financial rules for yourself and also have in the back of your mind, should you risk what you need for what you don't need? So when does paying off your mortgage not make sense? The easy answer is if you can get a higher percentage return on your money than your mortgage interest is costing you, but with no or little risk. That would in effect create an arbitrage, making you an easy profit. So if you're still on a 1 or 2% fixed rate mortgage right now, or you have access to very low interest rates for whatever reason, I can see how it makes complete sense for now to invest in something super low risk, like putting money in a high interest saving account or buying government bonds that right now are going to see you higher yields than those lower interest rates. But the moment your fixed rate mortgage increases to 4 or 5%, that arbitrage closes up. And the only way to make higher percentage returns on your money will be to invest in something else that will most likely be higher risk. So how do you find that right balance between paying off your mortgage and investing? Well, it's not easy. It's a decision that depends on your financial goals, your risk tolerance, and what you need versus what you want. For some, living in a bigger house with a bigger mortgage is worth the cost and the risk. For others, a smaller house with no mortgage brings peace of mind. Ultimately, the right choice is different for everyone. Let me know what you think in the comments below, and I'll see you in the next video up here.